Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular Markets Review Breaking the Mould, I'm going to be looking at mayonnaise, satellite TV and precision electronics. All three of these topics look capable of causing a fuss in the week ahead because we have on the same day, Thursday the 13th of October, interim results from broadcaster Sky, third quarter results from consumer goods giant Unilever, and then a trading update from Renishaw. So, let's start with Sky, whose share price is looking a bit sorry for itself after a grinding decline over the past 12 months, as we can see here. Now, to me, there seem to be three reasons for this drop. First, the market's still worrying about the rising cost of the broadcast rights for prime content like football amid greater competition from the likes of BT. Second, Sky's been jacking up its prices to help cover those costs, but that has increased churn, or the number of customers who leave the service. And third, profit growth has been petering out for some time. As we can see here, the consensus analyst forecast is for a 10% drop in earnings per share for the full year to June. Now, to combat all of this, Sky is looking to boost revenues from mobile and new services such as Sky Q. So when you look at the first quarter numbers, you need to look at 5 things. How close is Sky getting to its target of 5 to 7% annual revenue growth? Progress in a £300 million cost-cutting programme, new customer adds, which were 134,000 in the first quarter a year ago, new subscription additions, which came to 937,000 across all services last year, and finally, any comment on the Italian and German operations, where profitability was frankly pretty marginal last year. On the same day as Sky, the 13th of October, Anglo-Dutch food to personal care and hygiene giant Unilever is due to report its third quarter figures. The company owns Lipton's Tea, Hellmann's Mayonnaise, Dove Skin Products Domestos and many more brands beside, and these names do give it a degree of pricing power. Just look at the last 3 years, and frankly the first half of this one, to see how sales have grown pretty consistently despite the patchy global economic backdrop. Trends in volume, price and mix will be important in the numbers, while investors will also be checking out underlying sales and volume growth at the 4 product areas: food, refreshment, personal care and home care. We may also get an update on the $1 billion acquisition in the US of Dollar Shave Club, the company's first foray into male grooming. Do note, however, that boss Paul Polman has flagged that he expects slower sales growth and less margin expansion than we saw in the first half, the latter despite a drive to cut costs by €1 billion by 2018. Now, none of that may sound desperately exciting to you, particularly having to shave, but the shares have done well. The big jump you can see in this chart comes when the UK votes to leave the EU in June. That drove down the pound, something that flatters Unilever's sales and profits when they're reported back into sterling terms, as the FTSE 100 stalwart generates barely 10% of its business here in the UK. The big question now facing investors is what to do with the stock that's attracting the tag of expensive defensive, since it trades on nearly 24 times forward earnings with a 2.9% yield. The former's a premium, the latter a discount to the FTSE All-Share. What price are you prepared to pay for relative certainty in uncertain times? That's something only you can decide for yourself. And finally, we turn to FTSE 250 firm Renishaw, a company based in Gloucestershire but one that has a global reach. After a tough 2015 dogged by profit warnings, the stock has roared back in 2016, helped by its overseas exposure. Renishaw gets just 5% of its sales from Britain. Just under half come from Asia, a quarter from Europe and a fifth from the US, so the stock can be seen as a bit of a macro proxy. There's also one other issue to note. As we can see here, profits fell last year as some huge orders from Asian customers, thought to be supplies to smartphone kings Apple and Samsung, were not repeated. Apple's now in full-on iPhone 7 mode, and the analyst consensus is looking for a 15 to 16% bounce in Renishaw's profits this year, so let's see how the first quarter statement reads on Thursday the 13th. So thank you for watching, and I look forward to seeing you next time.